Welcome. Good afternoon, everyone. My name is Paul Prendergast. I lead Accenture's finance and performance management practice. What's that got to do with capital allocation? Because it's all about returns. And how do we actually allocate the capital in a profitable way across the value chain? I'm going to have a conversation here for the next 25 minutes, and we'll open it out to you, the floor. If we run out of steam, please, we welcome comments and inputs as we go along. And we'll make it as lively, hopefully not too controversial, but certainly interactive as well. I'm delighted here to be joined by Boipelo. Do you mind introducing yourself and why this is important for you? Yeah.
Thank you, Paul. I'm between the two Pauls.
Yeah.
Yes, I'm Wimpolo Lugubo, Financial Director for Harmony Gold. I joined Harmony in 2017 as a CFO, and then 2020 took the role of Financial Director.
Excellent. Welcome. Thank you. Paul.
Thank you. So Paul Smith, I was originally a fund manager for 7 years, and then latterly was 9 years at Glencore as head of strategy, principally responsible for capital allocation, which is why I'm here, I guess.
Excellent. So hopefully, we've got a learned group here to share with you. So clearly, capital allocation is complex, multifaceted, many challenges as you look at it, right? Not just the economic model, but the whole value chain. And then you throw in ESG, you throw in stakeholders, you throw in green energy as well. And it becomes even more complex, looking at your scenarios, you look at multiple assets and classes as you go along. So maybe we could just start with an easy one as you go along, your journey over the last few years, the growth, and then how you've managed the capital allocation and the framework accordingly. Yeah.
I think if you track the history of Harmony, and I'll start in 2016, because this is really where the portfolio started to change. There were a number of steps that we took in order to de-risk the Harmony portfolio, and that was really in the aim to create value and increase the quality of the ounces. And that was done through a really disciplined and responsible approach towards capital allocation. And I must stress, and all of this in the aim, obviously, of creating long-term value. This is also something that it's a through-the-cycle approach. So, through the ups and the downs, it's not about, when there's a boom, you're doing something different, just that consistency and the discipline. Our capital allocation framework is quite clear. I think that's one of the things also that creates confidence with stakeholders and investors. They know what you're doing, when you're doing it, and why you're doing it. And it's really all underpinned by our values and our goals. So yeah.
Oh, very good. And, it's interesting because, you've moved from one asset class. You were talking about now how you're building it out in Australia. What challenges does that lead to with stakeholders in terms of the returns and the focus and what they get out of it in terms of hurdle rates? Yeah.
So if you look, I spoke about value. A lot of the capital right now is being directed towards value. We've got organic assets in South Africa, which we are investing in, that's Mponeng and Moab-Khotsong. So there's a lot of runway, we're out of runway rather, let me say, in South Africa. Having a look at the gold landscape, gold M&A is expensive at the moment. So where we saw value was, you would have seen our acquisition of Eva Copper in Australia, and more recently the announcement of the acquisition of Mac Copper with the CSA mine in Cobar. And all of that really in trying to drive and deliver that value proposition and really bringing that copper story a bit forward.
Okay, thank you. Now, Paul, you've got an interesting career as you go through managing the hedge funds, then working with Glencore, and sort of that as well. What do you see as the key things to get right in capital allocation and how you manage that hurdle rate you mentioned as well? Yeah.
I think the thing that often operators of mines forget is, from a shareholder's perspective, success is very narrowly defined, really. It's about making money. So, and that often gets forgotten, I think. So capital allocation really is all about, successful capital allocation is all about returns. And yes, there are other elements of how you define success around ESG, et cetera, community relations, but ultimately it all comes back to that ability to make money, I think. That would be my observation, I think.
Okay. And clearly your organization having a rigorous, robust framework making sure that models are updated, it's embedded end to end. What's been critical to that success and driving the prioritization?
I think, I mean, you've got to get the process right. I think it's critical that people internally, particularly in a business like Glencore where it's very diversified by commodity and by geography, people need to understand what the rules are. And to the extent the rules change, then that needs to be communicated very clearly. It needs to be a simple process, but standardized. And I think it's the same, it's also important. I mean, the one thing you never do, the one thing shareholders, investor relations is quite straightforward, I think. It's you do what you say you're going to do. You try to. Obviously, it's a high risk industry, so nothing ever goes to plan. But you do what you said you're going to do as best as you can, and you react when things go against you. But what you never do is what you said you weren't going to do. So you have to be very careful, I think, with capital allocation, and certainly when there's a change in policy. People don't like surprises. I invest in this company for this. If you turn around and do something too dramatically, too quickly, it scares people, I think.
Yeah, I was going to say, I think that transparency is very important. People need to understand what lies ahead. I think if you look at us with that growth phase, it's well understood. We've got a clear dividend policy. Yes. People understand what they're going to get at the end of the day. And that project pipeline is very well mapped out. Yeah. So, to Paul's point, there's no surprises.
Yeah. And, stakeholder management is very important. It's not just the financial, but you've got the whole value chain. As a finance director, you've got investors, you clearly have communities, you have the green agenda. How do you balance that and ensure that consistency and visibility is there throughout to make the right choices? Yeah.
I mean, ultimately, it boils down to co-creation. People always want to be taken along with, and it's a simple concept, but we don't always get it right. And it applies across the board, whether it's employees, stakeholders, government, trade unions, our investors, shareholders, etc. If you are transparent, I go back to the transparency around what you are doing. It's clear, it's well understood. The no surprises element, then you do garner that support. And I think Harmony is a very good example of that. If you look at our relationships with unions, with employees, I would like to say our investors. Yeah.
Okay, very good. And as a consultant, it's easy to pontificate and talk about models and scenarios, right? But, what I see is it's the quality of data. It's the reliability of data that go into the performance metrics. It's the consistency of the measurement end to end and managing that as well as you do your scenario modeling. Paul, from your experience, both as a hedge fund manager, but also working with Glencore, how have you managed that and how have you filtered out the noise from the real data? And actually, have you used AI or Gen AI to help with that? Yeah.
I've never. I mean, I retired sort of 5 years ago in theory. So I've no sort of. When I was a CFO in, say, the Congolese asset, I think having that kind of access to something like AI would have been fascinating. But it was it was before my time, I guess. But look, in terms of AI. I've got some experience of this. I'm involved in a business called IntelliSense, which has some applications in some of the bigger copper assets. And again, I think it's AI, but really it's machine learning, I think, from my understanding of it. But it's really about the quality of the data, I think, at the end of the day. But again, very quickly back to there's a lot of noise around AI, a lot of sort of experimentation. But very quickly, if you're trying to sell that service, customers want to see actual deliverables and verifiable evidence that this thing works and what the objectives will be, I think, quite quickly. So it's like any other kind of fad or phase that things go through. There's a sort of hype period, and then I think very quickly companies get into the show me how this thing works, and I think that's kind of where we are. Yeah. I think the green thing's doing the same. It's really there's obviously less interest in just reducing, say, carbon footprint, less pressure to do so. But where you can combine that with actual improvements in efficiency, whether it's less diesel usage or whatever, then I think there's a lot of appetite for that. But ultimately, again, I would say this because I'm a financial person, but it does ultimately come down to
Yeah.
delivering value and adding value.
And
Yeah,
in your environment?
Yeah, I like what Paul said around, being careful not to have it as a fad. I think it was someone from Accenture actually who actually called it alien intelligence, because it's not actually artificial intelligence. I mean, at the end of the day, and particularly in mining, I think a statistic is that there's more data generated in mining than healthcare or retail, if you would believe. So it's what do you do with that information, and importantly, the integrity of that information. So although, machines can do a lot, there still has to be that human element, and it's garbage in, garbage out.
Yeah.
So it's very important to understand what it is that you need. It's all very fancy. A lot of things can be done, but ultimately, again, going back to what's driving value, you still need those elements of it.
And it's actually the interesting thing, on just my observation of AI, is actually there's a lot of open-mindedness and desire to kind of to experiment with it. And actually, the biggest impediment is usually when you get to the mine. There's a real kind of to get people to adopt things and to try things is actually is a real challenge, because you're interrupting, or you're perceived as interrupting a process that is broadly, in most cases, is working reasonably well.
Yeah.
So that kind of the biggest skepticism I see is the closer you get to the asset, the greater the skepticism.
As someone who's worked through, asset performance, key metrics, you're absolutely right. It's not about the quality of the data; it's the frequency of capturing it in the right buckets,
Yep.
to be able to drive the right behaviours accordingly. So, 100% agree. Now, as a finance director, we talk about trade-offs, right? And one of the things we talked about as well is how do you manage those trade-offs effectively across your network of stakeholders?
And again, it goes back to the understanding of what we are trying to drive and deliver. And the consistency in that communication, with various stakeholders, not just investors, employees, trade unions, as I said earlier. I think with us, it's quite clear that we are trying to drive that improvement of the quality of our portfolio. So there is that trade-off between, the short-term gains, investors do want dividends. We've just acquired an asset in Australia. So that trade-off between, do you invest in a copper asset or pay a special dividend? I think it was very well received in the sense that, this is near-term copper, improving counter-cyclical diversification, geographic diversification. So having people understand that view of where we are going. Mining is a long-term game. We've been hearing that all morning. It makes that trade-off, if you make it simple for people to understand, I think it's,
Excellent. Paul, any points that you've seen, sort of being on the other side as a sort of hedge fund manager, what do you look for as the trade-offs and the transparency, and what do you value more? Yeah.
Well, again, I think, I've always taken the view in both roles, actually, that there is a hierarchy of commodities and that not everything is equal. And look, if you were to, depending on what kind of a conference it is, if it's a gold conference, everyone will say gold, but broadly, everyone else will probably say copper. But actually, there's a justification of that. And again, a lot of people focus on demand, but the hierarchy of commodities, for me, I always looked at it as it's really about supply, and that's where, and that ability to get tightness in supply, but to sustain that tightness in supply, and therefore to have that supernormal profit. So yeah, you're going to get spikes in stuff like cobalt, but when a decent proportion of the cobalt market is a byproduct, then you're not going to get that sensitivity to price, and you will get, the sort of the elasticity is different. So that's an interesting dynamic as well, I think, in terms of where, because at the margin, if you can put, for me, you've got the kind of performance in absolute terms of, say a copper asset versus a zinc asset, but actually, pound for pound, I don't think those two commodities are equal. So that's another dimension, I think, to feature through. And it's interesting, what Harmony's done, because obviously the concern is always, if you're a gold company in terms of where the cost of capital is, there's always that nervousness, and Barrick's tried it as well. Yeah. Again, I think it's partly a timing issue, but if you're seen to go there too quickly, will that derate your stock? So again, I think that's another interesting dynamic, I think.
Okay, very good. New technologies and, carbon emission and impact on the environment, because as we look along the value chain so clearly we have the exploration, the development, and then we have our operational efficiency. How much weight have you put on sort of investment in new tech to improve your operational efficiency, and how's that helped in your capital allocation?
Yeah, I mean, with the operations that we have, it's fairly limited at this stage.
Yeah.
But we do have, people who are looking at ways in which we can obviously improve, firstly, safety, which is the number one priority, and then obviously productivity within the mine. So, it goes back to data, how we can, it's the easiest thing to, how do we leverage then on data? What is the data telling us, and what are the levers that we can pull in improving the overall productivity?
And Paul, you were sharing that when you worked as a partner, you looked at hydrogen and sort of really expanding that. Has that paid a dividend? Has that driven the operational efficiency?
I mean, hydrogen was always a, it's something I think for the 2030s or the 2040s. I mean, if you look at it in Europe, the rules are not even defined yet in terms of transportation. So, but I do think, again, moving away from fad, if you look at electrification, where it's coming out, I think both outside of China, certainly in terms of consumer, but also I think at the mine level, everything is going towards not pure electrification, perhaps, certainly not for trucks or for vehicles, but more hybrid, which again, I think with hindsight, is much more obvious. But again, I'm seeing stuff there where you're getting, if you can replace, say, put niobium in rather than graphite, you can get performance metrics that are where you have a payback on a diesel battery, against a diesel drivetrain of sort of 18 to 24 months. And that, again, is quite compelling. You can do it as you... So again, it's back to the numbers, back to the data. Show me where this is going to save me money. Yes, I'm going to also get some benefit. It's not going to be completely green. It's not going to be completely without emissions, but it's a significant improvement. And again, particularly for stuff indoors, it's underground. It's also has a lot of incremental value. So.
Very good. So clearly, it's multifaceted with many challenges, and as you look across the whole value chain, and that's interest and appreciated quite from investors, right? We want certainty of return, clarity of why choices are being made, and then the more consistent the choice, the higher your rating is. So when you engage with investors, right, who are keep on looking at what do they value, what do they see as the most important, and what for your journey over the last few years has really resonated with them. Yeah,
I think it's that consistency and predictability. Paul mentioned it. You should do what do what you say you're going to do.
Yeah.
Communicate early if you're not going to be able to deliver on those things. I think we've had quite a good run. 10 year, well, it was published recently. We've met guidance for the 10th consecutive year. So shareholders, reward us for that consistency in delivery. There's a lot of work we need to do around safety, but we do believe we've got the right strategies in place and that zero harm is possible. But ultimately, it's just around that consistency and predictability in what you're doing.
So the other key thing that we've seen over the last few years is ESG, climate change. And sort of as you look at development, what's the footprint going to be? And what's the return and that? Now, that's not quite consistent across all the countries, but clearly it's a key metric going through. How have you addressed ESG reporting as a sort of a way of tracking and then feeding that back out as well? Yeah.
So we have a saying in Harmony, we say we get ESG. I think we would not be operating, were it not, we've been through all these iterations, the triple bottom line, the triple Ps or all of that. It's not a metric that we do because we have to, we want to do it. It's the morally important thing to do. I mean, the E goes without saying. From a social aspect, that goes without saying. The communities in which we operate with, and governance, absolutely, that goes without saying. So it's an imperative which which, is a responsibility of everyone in an organization, including myself. It's not a department. So that is effectively how we've managed it.
And how have investors, and then how have the community responded on that?
Responded, fairly well, because as I say, we've articulated, be it in our reporting, integrated reports, what we're doing around ESG. Obviously, they're the various rating agents, but again, as I say, that's just a metric. It's not really what we are driving from that aspect. It's more the responsible thing to do.
Okay. And the social activities that you've been engaged in, do you want to bring those to life in terms of as you've expanded some of the existing assets? What for those have you sort of in sort of relating back to communities and impact as well?
From a ESG perspective,
Yeah.
I'm not quite following.
Okay. No, I'm just looking at, as you look at this, the social component,
Yes.
How central is that on your strategy? Okay.
No, absolutely,
Yeah.
absolutely. You cannot achieve any of this without, from a social, it's our license to operate.
Yeah.
So it has been well received.
Okay. Very good. Excellent. All right. Maybe any comments or questions
So
from
the
the floor?
questions all comes
Yeah.
through me.
Oh,
so
sorry,
you cannot
excuse
open
me.
up to the floor. You don't have the floor
Don't
to
have it.
open
I'll
up
let
to,
you
yeah.
let you do that then.
No, so we can put the questions as they come through.
Yeah, okay.
So I'm very happy to do that. Boipelo, can we talk a little bit? So in the last few years, people have implemented fantastic formulas for capital allocation. So if we look at a harmony, you would tell your shareholders, we're going to do first this, then that, or you're going to split the cake. So what is the harmony capital allocation framework? Just give us a sort of a...
So it's developed around 5 core areas in line with our values and our goals. I mentioned firstly, we will always prioritize safety and productivity. So capital will always be allocated there. And this then in no particular order really. It's a balance at the end of the day. Tracking the history, debt repayment was a significant thing we had to do, an over-leveraged balance sheet. Without that flexibility for a gold mining company is difficult. So, and we have done that, yes, albeit given the price, but you do need the ounces to sell to do that. So we've significantly, we're sitting in a net cash position as we speak. Then you talk around, the investment in our organic growth opportunities. And also, so where we are putting capital in is where the value sits. So a lot of capital going into, or major capital rather, our higher grade assets, being Mponeng and Moab Khotsong. And then again, the value accretive M&A, which we have successfully done now. But all of this centrally around improving or delivering long-term sustainable value.
And do you apply different costs of capital or return requirements for organic growth and for acquisitive growth?
No, this is a debate. Bankers as well, plug in whatever you want. We obviously, from a South African perspective, there would be a risk premium that would be attached versus looking at an asset in Australia. So there are those debates. I think we had interesting debates yesterday around, are we applying the right cost of capital in order to attract these investments from financial institutions. But yes, they would differ, just given jurisdiction, etc.
And Paul, can I put the same question to you? Should a mining company apply a different sort of rating or cost of capital to internal organic growth versus acquisitive growth?
Well, implicitly, yes. And then again, to me, the most, because organic growth should be the low, again, subject to caveat with, assume it's the same commodity, it's lower risk, right? So whether you do that through the discount rate or a lower risk rate, you should, again, it should be a safer, subject to, concentration risk, it should be safer. Good point.
One of the, and I want to link it to the question about staying business capital. One of the things I'm so glad I'm not a mining executive anymore, so we now give working costs the title of staying business capital, and then we make it part of capital allocation. But surely through the cycle, stay in business capital is not really capital. It's what it takes to run your business. So where does that fit in your hierarchy of capital allocation? Are you at all times adequately capitalizing your mines, even when the gold price is down? But you have not seen a down gold price. But if you could fantasize or theoretically assume a lower gold price, I mean, that's when it gets tough and real now.
Yes,
It's through the
yes,
cycle. So talk to
yes.
me about stay in business capital in harmony, and then Paul, perhaps you can comment from a...
No, absolutely. I mean, you do have to, obviously, you allocate capital to development, etc. That, I mean,
As I say, that's almost not capital now,
it
that's
goes
working
without
costs.
saying,
Yeah.
and it's fairly stable. I mean, I think the differentiation comes in to the major capital being directed to the higher quality ounces as opposed to...
Yeah.
to
In your portfolio, that's very relevant now.
Yes, yes. I mean, that generates 50% of our free cash. So it's important that is in place.
And I'd say I think that's the bit that people always get wrong, right? So if you look at sustaining capex, it's probably right for 2 to 3 years, but what it always misses when you look at it with hindsight is the step change, because actually it's not you can't really amortize it properly over a sort of 2 to 3 year period. So then you tend to get, which is why if you look at the sector, it always looks much cheaper than it should if you look at it on a cash flow multiple basis, because actually within that is not a smooth progression, but a step change. So, whether it's a salination, desalination plant, something that's not necessarily, because it's not gone into the budget necessarily, but it's coming at some point, and that's always the challenge, I think, in terms of, I think it's just a fun. It's not just you see this in other businesses as well, in manufacturing. There's a certain life cycle. But then, even within a 20-year asset, there's going to be major upgrades just to maintain production at some point that's kind of hidden. It's in there implicitly, but it's not necessarily spelled out.
Mm-hmm. And Boipelo, back to you. The allocation of capital in an African country, like South Africa, obviously sometimes would have preferred not to do it, but you have no choice. You become a water utility. You build a power plant. SLPs, the social labor plans, take you into stuff that you perhaps wouldn't have liked to have been in. So how do you weigh up, and I don't know where Harmonious will say the journey to green energy, independent from the national grid. Mm-hmm. How do you weigh those decisions up against a copper mine in Australia?
I mean, look, we definitely believe it, for us, has been cheaper to grow organically than an acquisition, especially given this gold price environment. I think what we're investing in the deepening of Mponeng and Moab-Khotsong will yield itself. If you just track, those acquisitions, we believe were very good deals. It's difficult in the context to compare that to a copper asset, for instance, which is why, the point I made that to do a gold M&A acquisition now, we found a bit difficult to do rather than the copper acquisition. But yeah, definitely growing organically will be cheaper per ounce.
And allocating 2 billion rands to a solar plant, how would that fit in your capital allocation framework? Would you be able to accommodate such a decision? How would you measure? How would you weigh it up?
Yes, no, definitely we do. We actually do have a renewable energy program in place. We already have 30 megawatts that is operating.
And what did that cost you? Probably about $1 billion or
So
billion?
it's about $1 billion. But
Yeah.
it's a quick payback. But that's on the 100 megawatts. The 30 is a PPA.
So Paul, mining companies end up doing lots of things which isn't mining. So do we just throw that all under social license to operate, or is that just what it takes to mine? Or, how do you weigh up a management team that does what needs to be done to mine? We build roads and corridors and power stations, and is this part of what makes mining a difficult space to invest in?
Like if you look at look at the next generation of copper projects in, say, Latin America, they're not. The real challenge, it's logistics. These are big logistics, operations, massive, with massive, an interconnected scope to get something wrong in terms of forecasting. So it's absolutely, it's the critical part, I think, of of a successful mining company to be able to handle that, and ideally to be able to either manage it in-house or, to be able to selectively procure those services. And then, of course, in terms of, financing, you want to just make sure as much of that, I guess, is off the balance sheet whilst being controllable as possible, I guess. But it's all about logistics and those kind of, what you would think is non-core. Getting the stuff out of the ground is kind of the easy bit. If you're trying to get something 400 kilometers across the Andes, that's, from 4,000 meters, that's where it gets difficult.
And I'll come back to the off the balance sheet, because I'm not sure it is always off the balance sheet, but we'll talk about that. Just in terms of this sort of peripheral other stuff that mining companies do.
Yeah, and just complementing what Paul said, I think it's really important to have the sort of operational infrastructure in place, not just the logistics, but just clearly the supply chain planning, but all the resource planning, and having the right data to actually forecast that. And then what we're seeing is, it's really then building more sophisticated models and be able to do that scenario modeling, and then updating those models on a regular basis, be it from the logistics, be it from the resource planning, et cetera, and carrying it through. So, your logistics point is absolutely correct. That's a real challenge. You can get into trouble really quickly if you get that wrong, right? Once you've got it out of the ground. So agreed. Yep.
And while I was thinking, Boipelo, I want to ask you, so if you were to develop a PV plant off balance sheet, is it really off your balance sheet, or are you still just... I mean, I've never met a CFO who says this is off the balance sheet, so I want to hear one saying...
No, I mean, from an accounting perspective, it would depend on how your contract
Of course,
is.
yeah.
Yes. So, I mean, the capital is off balance sheet. I mean, it depends how you want to... Again, it's the whole capital allocation. So, as I said, our 100 megawatts is actually on balance sheet. We are paying for it.
Yeah.
Yeah, my point was more sort of, look, I think particularly as the West wakes up to the fact that it's, it hasn't built enough stuff and it doesn't, either have processing or, in particular processing, there is a lot of funding. It's more a cost of capital issue. And, something like Exim, under one of the various schemes, there is capital available for stuff not in the US that's going to go to the US, and you'll be pricing it off. You shouldn't be financing, infrastructure, using too much equity, I guess was more my point.
No, absolutely. Boipelo, the conversation in the background through the 2 days is, and then we must add value, and African countries must get African producers to add value. Now, don't tell me a gold company can't do that. So why don't you allocate capital to downstream value adding? Why do you only want to mine? What's wrong with you, woman?
I thought you said we shouldn't. That's what I heard you say. No, I mean, look, ultimately, we are in the business of mining. So that is where we see the best value to be allocated.
But do you think you could make more money out of downstream beneficiation than out of mining? So let's say you were agnostic and you didn't mind to do other things. Would you do it could you build a business case for it, do you think?
I think you could, possibly, yeah.
Well, not in copper with negative TCRCs, right?
Yeah, no, it's such an interesting conversation because it's almost impossible to sit, in my case as a South African, and not want to see more reindustrialization. I mean, the Americans are obsessed.
This is the central challenge, right? When you have a province in China that's basically incentivized on effectively revenue growth, they will build capacity. And you want to rebuild capacity in the West, but actually without subsidizing it, which again, people are very nervous on a 25-year mine life. Trump tells you he's going to give you a subsidy for the next 4 years. He'd say, well, that's great, but it's probably not built. If it's a smelter, it won't be built within 4 years.
And then you have to have a bit of spare power, electricity, and a few other things at your disposal. Let me just round out the question. So, Dominique, the chair of Rio this morning. So, I mean, you could hear from the chairs, they speak much longer term, as you would expect. I think Venkat even said with us how his horizon changed as he stepped up from CFO to CEO to chair. But Dominique spoke about capital allocation and people in the same sentence. Investment in people. Now again, I'm sure in a harmony, it sits as an operating cost. But is that enough? Are you allocating enough capital to the very skills of the future? So we spoke about the ore bodies. You are doing it. Equipment, you claim to do it. People, you haven't even made the claim yet. So I want to give you the chance to make the claim that you're investing in future, in the future.
Mariana's not going to be happy because we actually spoke about this. The fact that, yes, it's not just, you know, the capital, there's other aspects of capital, you know, there's the human capital, the financial capital, and absolutely, I mean, we do invest in our people.
Through bursaries, through sponsorship of academic institutions.
Yes, and various, you know, various things that we do in order to make Harmony the employer of choice.
That as well, yeah.
Yes.
Okay. And so we take capital allocation, we make it after everything else has been spent, there's a bit of money left, who gets dividends, who gets what. But it's a very fake conversation now, because every rand of revenue is a capital to be allocated. You know, back to the different sort of time horizon. A final comment from you, Paul.
So I think it's still very complex, no matter how much scenario data we have, right? You know, we talk about AI, Gen AI. I think it's a bit slow coming, but it's going to come very fast. It is real, right? Clearly, the sophistication of the capital allocation frameworks, as you both like, is very important. But then the transparency and the consistency of how that's executed, I think, is ultimately so important. Because two things. Number one, it gets the faith of our stakeholders and our investors. Right? And then really gets that faith in terms of going forward of how we diversify and manage accordingly. Would I would summarize how it all up. Yeah.
Paul, final comments from you on this issue of capital allocation?
Well, I just pick up your point that you can have all the capital allocation, but your point on personnel and people, right? And mining is no different to any business, and look, particularly an execution business like this, particularly where you're trying to grow something, find something, develop something, you can have all the capital allocation processes you want, but if you've got crap people, you're not going to succeed, basically.
So, Boipelo, sorry, Paul, you wanted to comment on that?
No.
Boipelo, I mean, was it Muhammad Ali who said we all have a plan until we get smacked in the face? So we all have got a capital allocation plan until the gold price drops. Have you got a robust capital allocation plan for gold back at $1,500 an ounce?
Personally, I don't see that happening anytime soon.
No, but that was not a question. Neither of us know. So let's just theorize here. Now, I also don't think it will go there. But have you got a capital allocation framework that is built for all seasons, for a cycle?
I mean, we do hedge, so we hedge 30% of production. And we're not trying to predict, you know, what the gold price is going to be, or trying to predict a drop in the gold price. So we are particularly trying to lock in a margin above inflation and all-in sustaining costs. And it's short-term, very well understood by our investors. And what it does do is afford us at least time, you know, should things change, in order to rearrange or redirect capital wherever it needs to go. I mean, there are various other levers you can pull, mining for cash, etc. The one thing we do not do is drop our cut-off grades. I think that just in the long run, you probably also have scars on your back, you know, but not.
I've got no scars. Mining was easy when I was young. This woman never answers my question, and then she gives much better answers to the question I didn't ask. So, I mean, I can only be in awe always. So, thank you very much. This is a complex topic, and yet it is critical. Every single decision we make as leaders in an industry has got a capital allocation component to it. It's over different time horizons, and it's a cyclical business. Even gold is a cyclical business. I really thank you, Paul Boipelo. Thank you very much for a fantastic conversation. Thank you.
Well done. Thank you.